All right. Well, we're starting to get into the good stuff. So this will be the first video going into the details of the trading system and how to take trades. This will present the kind of most simple trade signal that I use to get into trades, print that EV, and build a system and make some gains out of. Let's get rolling. So the basic signal, which has been explained partly in some of my more primer type of videos, it uses the market structure and then a cross in the stochastic RSI that matches the current market structure. So in order to take this signal, for this signal to be valid and for us to enter a trade based on it, we need the market to form a clear structure. In the case of a long signal, this would be a low and then a high and then a higher low, which would show us that the market is doing that stair-stepping up type of pattern. And based on that, it would be likely to be valid to assume that market is going to continue to push higher and make a higher high. And so we will try and enter that in the higher low that the market is putting in when we take this signal. So market will be doing that structure, and stochastic RSI will cool down and reset to the appropriate upper or lower bound. In the long example, it'll be the oversold area at the bottom of the indicator. And once there, it will put in a cross, which in the case of a long will be a positive cross, which on my indicator is represented by the green arrow. Also represented by the white line, the fast line crossing over the slow line. So let's take a look at what that actually looks like. So the first thing we're looking for is market structure to put in a clear pattern for us to follow. In this example, we're doing something. We got a big dump. We put in a low down here. We push up, keep pushing up higher, and then end with a high up here. And then we come back down, and somewhere in here, we are thinking that it's likely that market structure will put in a higher low. On the stochastic RSI, we're down in the oversold area. We rotate back to overbought. We kind of clink around up here, put in some noise until eventually we get the cross that does play out in the full rotation back down to the oversold area. And once we're in this oversold area, we're looking for the stochastic to put in that cross, which will signal that this is perhaps the start of the next rotation from the oversold back to the overbought area. As an aside, as far as marking out the market structure, in the initial video, I gave kind of a guide for what I use. So on the stochastic, we go into oversold and then put in a first cross and then marking it until we get the last cross that ends in the rotation. That's how I think about it. In practice, it's a lot faster and kind of more just based on generalities. So I'll tend to do just smaller marks and follow price. So I'll put a mark at like the highest point that price gets before the stochastic puts in that rotation back down. And I'll put a mark at the lowest point that price gets to before the stochastic goes through the rotation back up. Just as I guess, an aside or an explanation of why these marks are where they are. I think visually it makes a lot more sense than it does to explain it. Like we can see that price puts in a low here, which coincides with the stochastic starting the rotation back, and then puts in a high here, which also coincides with a rotation playing out. Same thing here. Anyway, we have the parameters set for entering into a long trade, market structure. The stochastic cools down and goes back into the oversold area, and then we get the bullish cross represented by that tiny little green arrow there. So we enter the trade. Based on my system, we enter trades with a 3 reward to risk ratio. And the trade is entered when the bar closes that prints the green candle, which was this bar right here. That's the basics of it. As far as the details on the stop loss and how the take profit is set, depending on the size of the range chart, these are the number of ticks away from the entry I will set the stop. We can see here this was on the 16 range chart. So this is at 20 ticks away for the stop loss and then 60 for the take profit. These are the numbers. More or less, it rounds to the nearest factor of 20, which, like I said before, it if the bar size is 16, the 20 will completely cover that bar and also just give us a little bit of wiggle room. We're shooting for, not having our stop farther away than it needs to, because that's going to decrease our reward to risk ratio, but also having it close enough that like our ratio remains tight, but also not too close that we get chopped out by just price doing choppy little movements while the trade is still valid. So it's a balance to find. Sometimes it, doesn't work out either by being too tight or too loose. But uh, the majority of my backtesting, I found this to, be profitable and be approximately the best way to just set it. If you're setting a stop loss and take profit the same for every trade, which starting out I'll recommend you do for simplicity's sake. So that's how the stops are set. And then the take profit is simply 3 times whatever that stop loss amount is. So if you know what the stop loss amount is going to be, you know what the take profit is. The 3-to-1 reward to risk ratio keeps us profitable. Even if we're hitting under a 50% win rate, you're still profitable at a 3-to-1 ratio. 3-to-1 ratio is pretty strong. So another example of the same type of setup market structure is set. So we get a low and then a high, and then a higher low is put in. At the same time, the stochastic cools down and it goes back into the oversold area, and then we're hunting for that cross. Whenever we get the positive cross, we're going to enter that trade. This is on the 16 range chart again, so 20 pips for the stop and 60 for the take profit. You can see this one playing out here as well. This is a short example, so everything is the same, just flipped. We want market to put in that clear structure. In this case, we'll have a high and then a low and then a lower high because this is a bearish structure. You can also tell that we're underneath the 70 and 100 EMAs that I use, which provides a good approximation. Like you can tell that price is going down just based on where the candles and structure is relative to the moving averages. But mapping out the structure, we had a high up here off screen and then put in a low, lower high, another low, gets a slightly lower low than the one before it, and then a lower high again. We've got a clear bearish structure going on, and we're going to wait for the stochastic to get back into the overbought area. Then we're going to enter on a negative cross represented by the red arrow here. So we get in. This is on the 32 range chart, so it's a 40 pip stop, and then a 120 pip take profit for that 3 ratio. And again, we can see the trade playing out here. Successful short. So far, these examples have all been ones that succeeded. Initial, like very clean, structure is clear. The stochastic cools off and then puts in a single cross. We enter on that cross, and then we hit our take profit. It's 3 times as far away as our stop loss is. In the real world, you don't always win the trade on the first time you take it. So if you get in the trade and you get stopped out, you have a couple options. If the trade is no longer valid, the correct choice is to cut losses and look for the next trade. So we enter the trade and then it stops being a legitimate trade that we can take. So we stop, we take the 1R loss and live to fight another day. Like I said, you don't need to hit every trade to be profitable. When your risk reward is 3-to-1, you don't even need to hit half of your trades. So we try not to feel too bad if we enter a trade and the trade is valid, but just doesn't work and then stops being valid. You just rinse and repeat, move on to the next opportunity. If the trade is still valid, we will enter the trade again on the next stochastic cross. We'll go into what the term valid means here too in these examples. So in this one, we've got a similar bearish structure to the previous example. High, low, lower high, lower low, lower high. We enter on the negative cross once the stochastic rotates back and is in the overbought area. On this one, you can see that we just get stopped out pretty much immediately. So all of our parameters were set and this trade was legitimate. Price just wasn't ready to move yet and stopped us out. In this case, we would consider the trade to fail, but still be valid. We consider the trade valid because we are still in the area of a lower high compared to the last high that we hit. If price stopped us out and went up above the area of where this previous high was, we wouldn't consider ourselves to be in that clean downtrending market structure anymore, because rather than a high, a low, and a lower high, we would have a high, a lower low, and then a higher high, which wouldn't fit the bearish market structure we're hunting for. In this case, that doesn't happen though. We get stopped out, but price still remains in this lower high area. So we're going to enter the second trade on the next cross. Here you can see the first cross that led to us getting stopped, and then we put in another cross. So we'll enter there. This is on the 32 range chart, so 40 pip stop, 120 take profit. Boom, second time's the charm. We hit that profit target and win with a success overall, you know. If the risk for both was the same, we lost one and then we made three, so we made two overall, minus a small amount for fees. Slight aside, we'll get more into nuances like this later, but I do like this setup for the second trade because the stochastic is diverging. So we put in a cross, we get stopped out in price, but then the stochastic is moving down and the second cross is lower than the first one. So price puts in a cross and then moves a little bit higher, while the stochastic puts in a cross and then moves a little bit lower for the next one. Just tends to be a stronger signal than if the stochastic kept going up and put in another cross higher, which would indicate that, you know, momentum was still very strong and pushing upwards. Having the divergence here lets us know that the stochastic is slowing down and it's getting geared up for that rotation that we're trying to catch with our next trade. So I would be pretty happy to, you know, have a trade like this. Even though you get stopped out once, I think the second signal is very clear and very nice. So this example, the trade fails and stops being valid because the market structure changes. So this is a bullish structure example. So we've got a low here, high, higher low, higher high, higher low. This one is borderline. It's about an equal high, but could be considered a higher high, or it's close enough. Um, I think the wick is maybe a little bit higher here, so in real life it would pay to be cautious getting a signal like this. So the stochastic resets and gets back in the oversold area, and we get a cross, which is valid. If this area puts in a low, it's still higher than the low that came before it, so it would be considered a higher low. So we get the cross and we enter the trade, but we get stopped out. In the process of getting stopped out, price pushes lower and gets to be lower than the low that came before this area in market structure. So we know at this point, when these candles are playing out down here, that we're no longer in a higher low, but we are in fact in a lower low, which is not what we want to see in this bullish structure we're kind of trying to capture trades in. So we would get stopped out here, and then the trade would no longer be valid, so we just wouldn't enter again. In fact, if you looked at the high here and then this area as a low and a lower high, this would be a spot that it would be valid to start entering a low in, or a short rather. So we had an example of, you know, failing and having a legitimate second entry and then failing and not getting that legitimate second entry. So those were the very basics of how the system works. We'll get some more into nuances in later videos. Knowing what you know here, you can hop on charts and start mapping these out and looking for them on your own. Potentially even taking some trades at this level. You could only look for trades that meet these criteria, and this would be a profitable system. So If you're looking to get in the charts a little bit and start looking for trade setups on your own, you have what you need to look for some basic ones at this point. Happy hunting. I'll see you in the next one.